In this video, I'm going to walk you through the exact detailed analysis that I've used to acquire over 40 rental properties and property flips, and to ensure that not only do I cash flow from day one, but I know how much I will cash flow. And best of all, we're going to use a real life example of a property that's currently on the market and actually assess if this thing is going to cash flow well or not. Okay, so I actually use a couple different charts when I'm assessing rental properties, but this particular chart is all about cash flow, helping me understand if this property is going to cash flow or not. That way I know if it's a good deal. Now, the mistake that most investors make is they just simply look at what's my total monthly payment of mortgage. So let's say $3,000. And then they think, well, great, I'm renting it for $3,200. I'm going to cash flow $200 a month. It's not that simple. So let's break down all the ways in which we can assess this. And then at the end, we're going to use a real life example of a property on the market, and we're going to practice putting it in there and seeing whether or not this thing would cash flow. So at the top here, we have our just overview, and this is just a way to organize all your information and get things tidy. So the first thing is number of units. So if you're just looking at a single family home, it's got one door, it's just one unit. If you're buying a duplex or looking at a duplex, it'd be 2 units. Threeplex, 3 units. If you're buying a big apartment complex, let's say with 20 units, it'd be 20 units. Next is going to be the asking price. Then we're going to have the monthly rental rate, which is the total amount of rent. So if you're just buying a single family home, it'd just be what's the monthly rent. But if you're buying a duplex, you would add both rents on there. So let's say one unit rents for $2,000, the other unit rents for $3,000. That's a total of $5,000 that you'd put here for monthly rental rate. Renovation costs. So if you are expecting to renovate this place in order to get it rented, you'd put the estimated total cost there. The net operating income, that is actually something that will auto-populate as we go along, so you don't need to do anything there. And then just bank loan information or private money. So let's start with the income portion, because when you're assessing cash flow, there's income and then there's expenses. So let's start with income. So on the income portion, the first thing we're going to look at is the gross potential rent. Now this is going to auto-populate as you type in over here your monthly rental rate. So obviously if you had, let's say, a unit that was renting for, let's say, $2,000 a month, you'd put that here. And as you see, it would automatically populate and it would show $24,000 for the year. The next thing is going to be your other income. So other income is going to be additional ways in which this property could generate revenue. So it could be things like coin laundry or vending machines, or perhaps you have premium Wi-Fi cable channels that your tenants can purchase from you that would allow you to charge more rent. It could be additional storage that you rent out. There's a lot of different ways in which you can make additional rents from your rental properties. So you'd put the total yearly estimated income from there. For our purposes, we're just going to put 0. And then this will give us our gross potential income. Your gross potential income is the total amount of potential income that you can get, assuming that your property is rented the whole year. But your property is not always going to be rented 100% of the time, and that brings us to vacancy rate. So your vacancy rate is the percentage of time that your unit is not occupied. Now, there's a whole science behind this, and I can't get into every market and all that stuff, but generally in good markets, you're probably looking at like 4 or 5% up to 6, 7%. In low income or bad markets, it could be as high as 10% or more. I like to be pretty conservative. In this particular chart, I have 6%, which I think is kind of a medium grade. A lot of times when I'm doing properties, I'll have it as high as like 9 or 10% for worst case scenarios. But right now it's at 6%. If I wanted to change that to say 7%, I'd go up here and I'd change this, let's say 7%. But we'll just keep it at 6. Doesn't really matter right now. And so what that means is I'm going to miss out on about $1,440 on average per year in missed rents. Now the misconception is like, well, I have a property that's been rented for 2 years and they've been there the whole time. I haven't missed a payment yet. That will happen. You will have periods where this happens, but tenants are always going to move out at some point. There's going to be turnaround. So you always want to calculate for potential lost income. The key to being a successful real estate investor is to pretty much plan for worst case scenarios of what if tenants move out and it takes me a month or two to re-rent the place. So you want to have that embedded into your calculations so that if the worst case does happen, you know that you're still going to be okay with this deal. So this brings us to our gross collected income. This is going to be your total potential income minus the vacancy, and this will give you an expected yearly income of your property. And in this case would be $22,560. Now this brings us to the expenses side. So the first thing you want to think about, insurance costs, taxes, utilities. And once again, these are all yearly amounts. Maintenance. So your maintenance is going to be all the expenses that you have throughout the year that are just general repair. Tenant calls and says, hey, my toilet's not flushing properly. You got to call a plumber. Or my sink is leaking. When you have rental properties, there's always going to be something that goes on. And so what you want to do is you want to budget for that. Now, this is on the very high end of estimations. Once again, I'm very conservative with my numbers and I really try to plan for worst case scenarios. 10% is quite a bit. This really depends on the age of your property. If you have a brand new built home, you're probably not going to spend 10% a year in the beginning on maintenance. It might be as little as 1 to 3%. But if you have an old property that's 50, 100 plus years old, you very may well actually have 10% or even more in this. So I have it at 10%, it doesn't really matter, but this means that you can expect to spend $2,400 a year in maintenance. Next is management fees. So one thing you'll need to assess is if you're going to manage this place yourself, or if you don't want to have to deal with it, you're probably going to pay a property manager. On average, most property managers are going to charge around 10%. Some charge a little more, some charge a little less. It just depends, but you have that in there. Other expenses, things like capital expenditure. If you've read the guide or you've gone through it, then you know what capital expenditure is, but it's going to be additional repairs that you do to the property above maintenance. So while maintenance is things like our toilet's clogged, the sink is leaking, your capital expenditure is going to be improvements that you make to the property to continue to make it nicer and better along the way. What you put here really just depends. This is at 10% right now, but you can do as little as 3%, 5%. It just depends on the age of the property and your overall investing goals and plans. And this would bring a total amount of expenses to $4,800 a year. So we take our gross collected income, which is $22,560, and we subtract our total expenses, bringing us a net operating income of $17,760. Now, important to note, because someone thinks, wow, this is a lot of money. Well, this doesn't include your mortgage payment. So parts will depend on the purchase price. You're going to enter in how much you're going to pay for this property, renovation costs, any carrying costs, and this will bring you your total amount of costs. So like, let's say that you're paying $500,000 for this house. No renovations, no carrying costs. Well, your net operating income was $17,760. You divide that by your total cost, how much it cost for you to buy the house, and that would bring a cap rate of 3.55%. Now, once again, if you've read the investing guide, then you know what cap rate is. If you haven't read it yet, be sure to do so. And if you haven't downloaded it yet or signed up for our investing guide ebook, then definitely be sure to go to our site, download our free ebook, which is a 74-page step-by-step guide, very detailed. But your cap rate is essentially going to be, if you paid cash in full for this property, $500,000 cash payment for this house, it's your expected return after having paid cash. So 3.5%. Now from here, we need to look at your loan, okay? Because most people don't pay cash for a property. Most people are putting a down payment and getting a loan for the rest. So we do need to assess that. So we have total cost. That's how much you're paying for the house. The next thing you're going to do is you're going to type in the percentage of the loan to value. So for instance, if you're putting down, let's say 10% on a property, then your loan to value would be 90% because the bank is loaning you an additional 90% so that you can buy the house. You're putting down 10, they give you the other 90% that you got to pay back, which gives you your 100%. If you're putting 30% down on the property, then the bank is loaning you 70% more of that. So the financing amount in this case would be $350,000, assuming you put 30% down. And then next is the financing rate. So that is the interest rate that you're going to pay. Now, obviously that varies all the time based on the market conditions, stuff like that. In this particular case, you just put down 6%, which means that the total cost of financing is going to be $21,000. This section here is a little different. So this would be if you are also, in addition, are raising capital outside of your own money. Well, this would be where you calculate this stuff. So let's say in this particular example, right, the bank's going to loan you 70% of the value, but you have to come up with the other 30%. And let's say that you don't want to put any money down. You're like, you know what? I'm going to acquire this property, none of my own money. I'm going to raise money from other investors, friends, family, whatever, and I'm going to give them a percentage of the profits. Well, then you would say, okay, I got to raise 30% of the 500,000, which is 150,000, and I'm going to give these people a 10% return. Well, then your cost is going to be $15,000. So then you have your total cost of financing plus your cost of private money, means your total cost of capital is $36,000. And this is what's known as your blended cost of capital. So blended cost is the cost of capital for the loan and the cost of capital for any money that you raised. Most people watching this video are not syndicating or raising other capital. They're just putting their own money down and getting a loan for the rest. All right. But if you were doing something a little fancier, that's what you do. And what that would mean is that your blended cost of capital percentage, so like the total combined interest rate, if you blend it, is 7.2%. Remember, we had a 6% rate from the bank for $350,000. And then we also had a 10% loan that we're giving to all the people that are borrowing money from at 10%, and that's $150,000. So the total combined is going to be an average of a 7.2%. So what does that mean? I understood the income and the expenses, but once you got to this whole like loan stuff, it's crazy. It's very simple. Once you put in the amount of the total loan and how much the bank's going to loan you, it's going to spit out a number, cost of capital, okay, 7%. The way you know if your property is going to cash flow or not is if your cap rate, okay, so this number right here is greater than your cost of capital. So if your cap rate number is bigger than your cost of capital, it's good, it cash flows. That means that's going to be a decent deal. However, like in this case where cost of capital is 7.2% and your cap rate's only 3.5%, that's not good. That means you're going to lose money every month. Now, if I absolutely lost you there, which is totally understandable if I did, there's another easier way of doing it too. All you do is go back up to your net operating income, and you're going to compare that to the yearly payment of your mortgage amount. Okay, so you would just look at how much loan you're trying to get at what interest rate from the bank, look at what your mortgage payment would be. So like, let's say if your payment was $2,000 a month, well, $2,000 times 12, and then you would compare that to your yearly net operating income. And if your net operating income is higher than your yearly mortgage payments, that's how much money per year that you'd probably cash flow. If it's less than, then that's how much money you'd probably lose per year. So that's really how you do that. Let's go ahead and take a look at a real life example of a property that's listed, and we will apply that to this spreadsheet, and let's see how the cash flow turns out. So here is a home that is on the market currently. It was listed about 3 days ago. It was built in 2014, single family home. It's a 4-bed, 3-bath, just over 3,000 square feet. So a really great family home, looks really nice, and is renting for $36.50 a month. Now the taxes are around $3,100 a year, and we're gonna go ahead and estimate the insurance to be about $200 a month. Obviously there's some variables there, but let's go ahead and take all this information, put it into our spreadsheet, and just take a look at how something like this would cash flow. Okay, so going back to our spreadsheet here, number of units is gonna be 1, it's a single family home. Remember, if it was a duplex, you'd put 2. Asking price, so the estimated value of this is about $650,000. You need to get an appraisal, and depends on what it would sell for, but $650,000 is what like the Zestimate or estimated cost is for it. The rental monthly income is $3,650 like it was listed. So let's assume that, you would be able to get something like that for rent. Now the place looked really nice, new, didn't look like it needed any repairs. So renovation cost would be 0. So let's go ahead and jump into this. So with $3,650, it looks like the total yearly gross potential rent would be $43,800. We're going to put $0 for additional income. In terms of the vacancy rate, we're going to put it about 5%. 5 or 6% I think would be a pretty good estimate. And that would bring you to a gross collected income of $41,610 per year, assuming about a 5% vacancy rate. Now, in terms of the expenses, we're going to assume that the insurance is about $200 a month. That is just kind of a rough ballpark. Could be more, could be less. Obviously depends on how much coverage and, all kinds of things, but we'll put about $200 a month. When I looked at the taxes, it's around $3,100 a year. Utilities will put at zero. We'll have the tenants paying the utilities. Maintenance costs at 10%. I don't think you would need 10% for this. It's built in 2014, so it's not a brand new property, but it is fairly new. So the odds of needing a lot of maintenance in the beginning is probably pretty slim. Now, as the property ages over time, this number would need to change, but I think you could do like half of that, maybe like 5% for maintenance. You wouldn't put zero, even if it was brand new, even if it was like you're buying it, just got built, it's not going to be zero. You're going to have some maintenance you want to calculate for. Management, we'll just assume that you're going to manage it yourself. Capital expenditure, remember, this is above and beyond repairs that you want to make this place nicer, better, more attractive. This is a pretty new property. I don't think capital expenditure is going to be too high. Right now, we have it at 10%. Let's move that down to, let's say 3%. Probably not gonna need a lot in the beginning. As it ages, you might readjust these things. Or if you just wanna start from the beginning and say, hey, I wanna pre-assess and get ultra conservative here, then you would do that. This would bring your total yearly expenses to $9,000. If we take our gross collected income, subtract our expenses of $9,000, this leaves us with a yearly net operating income of $32,606. Remember, this does not include your mortgage. This is not your net profit per year. This is your net operating income without your mortgage payment. So two ways you go about this. The one way is you would just go ahead and calculate your estimated mortgage amount. So if you're getting a loan, put your loan amount, the expected interest rate, and see what your monthly payment is. Multiply that by 12 and compare it to this. But if we go down here, we'll put $650 purchase price, no renovations. Right now you're sitting at about a 5% cap rate. So assuming that these variables are accurate and correct, if you paid cash for this property, you'd probably get pretty close to a 5% cash on cash return for the money that you're putting down, the $650,000 you paid cash. And then if we go to the other way of assessing cap rate and cost of capital, if we have $650,000 purchase price, let's say we're putting 30% down, so a 70% loan from the bank. You're financing $455,000. Let's just say that you get a 6% interest rate. Could be a little bit higher where you're right now, or it could be lower, but let's just say about 6%. That means your cost of financing is $27,300. So in terms of the private money, even though you're not going to be raising capital and offering interest rates to those people as well to purchase properties, or at least more than likely you're not, it's still going to be important to maybe take a look at. So if you wanted to kind of pay yourself an interest rate on the money that you're putting down, it's something to look at. So for instance, if you're putting down 30% on the property, so $195,000, and you would like to see if you could basically pay yourself a 5% return for that money that you're putting down, your property would need to generate an extra $9,700, a little over that, per year. So the cost of the money from the bank plus the cost of paying yourself some money, your blended cost of capital would be 5.7%. Well, if you compare that to the cap rate of 4.3, the cost of capital is more than the cap rate, so you wouldn't be able to make that deal work. You wouldn't be able to pay the bank their, let's say 6%, if that's what they're charging you, pay yourself a 5% on the money that you're doing and still cash flow. So you would just need to play around with it a little bit. So could you give yourself a 3% return? 5 and 4.3. Still not quite there. Well, let's just see if you didn't worry about paying yourself an extra premium on your money and you were just like, you know what, like this is just my money down. I'm just going to put it in the property. I'm not worried about generating cash on cash return, but I would just want to make sure this property, now that I put this money down, can support the payments and all of that with the bank. Well, 4.2 is less than 4.3. Well, you can absolutely do that. So this is where you want to play around with it a little bit. And then keep in mind, there may be some other ways in which we can generate a little more revenue. Maybe you find that you can rent it for a little bit more than $3,650. Or maybe you decide, hey, I'm not going to pay full asking price for this. I'm going to pay $625,000. which is going to increase your cap rate up to 4.5. So not a huge difference, but it does do a little bit. And then you can look and see if there's other ways in which you can reduce your costs. Maybe maintenance is not going to be 5% like we calculated, in the beginning, maybe less. Or, in this case right here, I've got 10% management. If we said, hey, I'm going to manage it ourselves, right? That's going to change things substantially too. So that brings you up to a 5.2% without management. So now we have a big buffer. So then you come back over here and say, okay, well, now I made these adjustments. Could I give myself a 3% return at that point? 5.1, 5.2, I could. Okay. So as long as I manage the property myself and I acquire this thing for $625,000, well, I could give myself a 3% return on the money I'm putting down and still support all the payments that are required for that. And that's how you know that this deal would work, because your cap rate is still higher than your blended cost of capital. So hopefully that makes sense. If that last part still is really confusing to you, like I said, all you got to do is you can basically go back to your net operating income of the 32,606, and you would subtract your yearly mortgage payments. So let's say that your yearly mortgage payments were, I don't know, let's just say $25,000, so you're going to net $7,000 a year. All right, $7,000. Then you would know, okay, over the course of the year, I'm going to make a net profit of $7,000. And then if you want to figure out what your return on investment is, you take the $7,000 divided by how much you invested. So in this case, if you put down 30%, you had $195,000. Well, actually, in this case, at 625, $187,000. Then that would be a 3.7% return. But yeah, so that's how you're going to navigate the different ways of determining if something cash flows or not. Now, if you haven't done so already, I would highly suggest that you check out our real estate investing guide. Let me show you that really quick. So if you go to our site, seansurgeon.com/real estate investing guide, we have put together a phenomenal, very detailed step-by-step guide. This is 74 pages of everything that you need to know. It's a culmination of the 40 rental properties and property flips that we've done personally, in addition to working with other clients, helping other investors buy rental properties as well. And this would give you really good insights into everything you need to know. And here's what it entails. So on the site, we actually have a video walkthrough going through a lot of the pages that you'll be getting in the guide, just to make sure it's actually worth downloading for you. You don't waste your time. But you'll be learning the power of real estate investing. We give some really good examples of how much more equity you can build buying real estate than even stocks that earn a higher return. Also, we cover essential investment terms. I've used a lot of terms in this video, such as like ROI, cap rates, but we also talk about loan types, contingencies, title insurance, all these things you're going to hear throughout the process of buying a property, and the most important things you'll need to know. How to build your investment team and who needs to be on that team to ensure that you not only get the deal, but you really protect yourself and you are able to build a portfolio. We have a step-by-step guide for buying a property. So there's 10 steps that go through every single process, from before you buy to the process of buying, financing, closing, assessing deals, analyzing properties, all kinds of great stuff, how to maximize cash flow and ROI, and how to manage and optimize your investment. In addition, if you want, you can opt into our weekly strategies and insights. This is where we give a weekly email of all kinds of tips and strategies on just how to invest in properties, how to build a portfolio, and create generational wealth. And then we have a little bit about us, the S&S group. This is Shannon and I. Our mission is making generational wealth build ridiculously simple. And we are here to provide as much knowledge, insights, and value to you on your investing journey so that you can create the financial goals that you have for you, your family, your loved ones, or whoever else.